Hey, Money Masters! Let's get straight to the truth. In the United States, your credit score is your financial passport. It's not just a number. It's the silent gatekeeper to the cheapest loans, the best insurance rates, and even some apartments and job opportunities. If your score is struggling, or even if it's just average, you are paying a financial penalty every single month. You reap paying hundreds or even thousands of extra dollars in interest over the life of a car loan or a mortgage. I am here today to tear down the mystery surrounding credit scores and give you the exact blueprint I used to break the elusive 800 barrier right here in the USA. This isn't theoretical advice. It's a detailed, actionable guide to mastering the FICO score. We're going to cover the 5 pillars of credit, reveal the golden rule of utilization, and give you a month-by-month plan to accelerate your score from decent to dominant. Stop paying the high-interest tax. Let's build your 800-plus score, starting right now. Before we start building, we need to understand the architecture. The vast majority of lenders in the US use the FICO score, and it's calculated based on 5 weighted categories, or pillars. If you ignore even one of these pillars, you will never reach that 800 mark. Pillar 1 is payment history, and it's a massive 35% of your score. It's simple. Do you pay your bills on time? Your goal has to be 100% on-time payments. A single missed payment, even 130 days late, can drop an excellent score by 50 to 100 points. The action here is to automate all your payments. Set up autopay for every credit card, loan, and bill. You must take human error out of this process. If you can't pay the full balance, at least pay the minimum on time. Next up, Pillar 2, amounts owed or credit utilization. This is the second most important factor, weighing in at 30%. This is the ratio of how much credit you're using versus how much you have available. The golden rule is to keep your credit utilization below 30%. Then we have Pillar 3, length of credit history, which is 15% of your score. Lenders want to see a long-established history of responsible borrowing. Your score improves simply by getting older, financially speaking. The action is crucial. Never close old credit accounts, especially your first ones. Closing an old card shortens your average account age and reduces your total available credit, which instantly harms your utilization ratio. Let those old accounts age gracefully. Pillar 4 is credit mix, making up 10% of your score. Lenders like to see that you can responsibly handle different types of credit. This means having a mix of revolving credit, like credit cards, and installment credit, like mortgages, auto loans, or student loans. But don't take out a loan just for the mix. If you already have student loans and a credit card, you're fine. The goal is balance. Finally, Pillar 5 is new credit, the last 10%. This tracks how often you apply for new credit. A hard inquiry happens when you apply for a credit card or loan, and it temporarily dips your score a few points. A soft inquiry, like checking your own score, has zero impact. The action here is to be strategic. Don't apply for new credit just to get a free t-shirt. Space out your applications by at least 6 to 12 months. Now let's talk strategy. Credit cards are the most effective tool for rapidly improving your score because they directly impact your utilization. To get to 800 plus, you have to use credit cards correctly. And here's the utilization mastery hack, the prepay rule. This is the single most powerful strategy for boosting your score immediately. Most people think you have to wait for your statement to close and then pay the bill. The reality is, your credit report shows the balance on your statement. If you charge $800 on a card with a $1,000 limit, your utilization is 80%. Here's the hack. Pay down the balance asterisk before asterisk the statement closing date. If you charge $800, make a payment of $750 1 week before the statement closes. The statement will then report a balance of only $50. Your utilization on that card is now a stunning 5%. I did this for months, and it worked wonders. I paid my balance 2 or 3 times a month to ensure the reported balance was always tiny. Another way to lower your utilization is to strategically increase your credit limit. Periodically request a credit limit increase on your existing cards. This increases your total available credit without increasing your debt. And a pro tip. Many credit card companies let you request an increase using only a soft inquiry. Check online first to make sure it won't trigger a hard inquiry. Finally, for an account to positively impact your score, it has to be active. Lenders don't care about a perfect card you never use. So use every card you own at least once every 3 to 6 months. Even a small $5 purchase that you immediately pay off keeps the account active and reporting positively. Next, the cleanup phase. You can't build a beautiful house on a cracked foundation. If you have negative items like collections or late payments, you must address them. If a debt has gone to collections, contact the collection agency and offer a settlement, say, 50% of the debt in exchange for them removing the item from your credit report. This is called a pay for delete. Get this agreement in writing asterisk. Before asterisk, you pay a single penny. You also need to dispute errors. Up to 79% of credit reports contain some type of error. Get your free annual credit report from Annual Credit Report. Calm and review reports from all 3 major bureaus: Experian, Equifax, and TransUnion. If you find an error, dispute it directly with the bureau. They have 30 days to investigate, and if the information can't be verified, it must be removed. What about late payments? If it was a one-time slip-up, you can try sending a goodwill letter. This is a heartfelt, polite letter to the original creditor, acknowledging the mistake, explaining the circumstance, and asking them to remove the late mark as a gesture of goodwill. It doesn't always work, but it's definitely worth the effort. Now let's put it all together in an accelerated 12-month plan. This is perfect if you're 12 to 18 months away from a major financial goal like buying a house. In months 1 to 3, focus on foundation and cleanup. Pull all 3 credit reports and dispute any errors. Calculate your credit utilization ratio. And most importantly, implement 100% autopay for all bills. 0 missed payments allowed. Months 4 to 6 are about utilization dominance. Your goal is to get your utilization ratio below 10%. Use the prepay rule aggressively on all high-balance credit cards. Make multiple payments per month. If you have high-interest credit card debt, consider consolidating it into a lower-interest personal loan. Months 7 to 9 are for the limit and mix boost. Request a credit limit increase on your oldest, best-utilized card, checking for soft pulls first. If you have no credit cards, consider opening a no-fee card and using it for a tiny, recurring expense that you pay off immediately. But do not apply for any other credit during this time. Finally, months 10 to 12 are the waiting game. Do nothing except maintain your perfect payment history and low utilization. The biggest boost comes from showing 6 to 9 months of consistent, perfect behavior. After the 12th month, you can start shopping for a mortgage or car loan, minimizing the impact of hard inquiries. Congratulations! By following this blueprint, you are now in the elite tier of American credit users. But hitting 800 is not the end. It's the beginning of a life of financial advantage. An 800-plus score gets you the best mortgage and car loan rates, potentially saving you tens of thousands of dollars. It can even lower your insurance premiums. To maintain it, never miss a payment, keep your utilization under 5%, check your reports annually, and keep your old accounts open. The path to 800 is about consistency and intentionality. You now have the ultimate credit score blueprint. The hardest part is starting. So your homework today is to pull your credit report and calculate your current credit utilization ratio. Let me know in the comments. What is the #1 thing you are doing this week to improve your credit score? If this deep dive was valuable, hit that like button. Subscribe for more advanced finance strategies, and I'll see you in the next video.